a company that has advised governments, rebuilt global supply chains, and deployed more enterprise AI than almost anyone else on the planet, just lost 16.5% of its market value in a single trading session. That is roughly $30 billion of market cap erased before lunch. The question is not just what happened. The question is whether the market got it right or whether it panicked. Because those two answers lead to completely different decisions. And knowing which one this is could matter more than almost any other call you make this year. Accenture reported quarterly earnings in June 2026, and the surface numbers were not catastrophic. Revenue came in near consensus. Earnings per share held up. So, why the violent reaction? The answer lives in the forward guidance, not the backward-looking results. And this distinction is something that trips up even experienced investors. Management revised its full-year revenue growth forecast downward. The company had previously guided for growth in a range that implied continued momentum in its AI and cloud transformation practices. What they delivered instead was a meaningfully narrower range, with the midpoint sitting below what the analyst consensus had baked into price targets. In a stock trading at a premium valuation multiple, Accenture had been running above 28 times forward earnings. Guidance cuts hit harder than in cheap stocks. You are not just pricing current earnings when a stock is that expensive. You are pricing growth, and growth just got repriced. Beyond the numbers, management commentary flagged something more structural. Enterprise clients are extending decision cycles on large consulting engagements. Translation: corporate spending committees are taking longer to approve the multi-year transformation contracts that are Accenture's highest margin revenue. In a tighter capital environment in 2026, CFOs are scrutinizing discretionary IT spend more aggressively. The AI build-out that was supposed to accelerate bookings is still happening, but the timeline has stretched. The actionable insight here is specific. When evaluating any services company with premium valuation, read the bookings data and the book-to-bill ratio before you read the EPS line. Accenture's backlog trajectory told a cautious story before this print. The price just hadn't adjusted yet. 16.5% is a large number to absorb when you are looking at a company with $50 billion in annual revenue, 19 of the 20 largest global corporations as clients, and a workforce of over 750,000 people operating across every major industry, vertical on Earth. The skeptical case against this sell-off deserves serious airtime. First, consider what Accenture actually does that is structurally hard to displace. Enterprise technology transformation is not a commodity market. A company that has spent 15 years building proprietary frameworks for SAP migration, cloud architecture, and now AI deployment across regulated industries does not lose that positioning because one quarter's guidance disappointed. Switching costs in enterprise consulting are enormous, not because clients cannot leave, but because the cost and disruption of moving a mission-critical transformation midstream is prohibitive. That moat is still intact this morning. Second, the sell-off is partially sentiment contagion. When Accenture moves this sharply, it signals to the entire IT services complex, Cognizant, Infosys, Wipro, IBM's consulting arm, that enterprise discretionary budgets are under pressure. Investors are not just repricing ACN. They are repricing a thesis. That macro repricing creates indiscriminate selling that often overshoots the actual fundamental damage. However, the bear case is not nothing. If enterprises are genuinely slowing AI implementation decisions, and there is corroborating evidence in 2026 from slower hyperscaler professional services attach rates, then Accenture's growth trajectory for the next 18 months has real headwinds. This is not financial advice, but the math on whether the drop is justified depends entirely on whether the guidance cut is a single quarter conservatism or a signal of structural demand softness. History says the market often overshoots on the first read and corrects within 60 to 90 days. It also says sometimes the first read is exactly right. The most valuable thing you can extract from a day like today has nothing to do with Accenture specifically. It is the pattern. And this pattern repeats across sectors with near-mechanical regularity. Understanding it turns a confusing event into a template. Here is the anatomy of a high-valuation guidance cut. Premium multiple stocks carry embedded growth expectations in their price. When those expectations are reduced even modestly, the mathematical impact on fair value is amplified because you are discounting more future cash flows at a lower growth rate over a longer duration. A 5% cut to a long-duration growth estimate can rationally justify a 10 to 20% price revision. This is not irrational market behavior. This is duration risk in action. And it is the same mechanism that punished growth stocks broadly when rates rose in 2022. The second piece of the pattern is what happens in the weeks that follow a drop like this. Research from multiple market cycles consistently shows that stocks dropping more than 15% on an earnings miss, followed by guidance cuts, tend to exhibit one of two trajectories: a base formation and recovery over 60 to 90 days, if the guidance cut was conservative management sandbagging, or a continued grind lower over 1 to 2 quarters, if the guidance cut was actually the first admission of a longer cycle problem. The diagnostic tool for distinguishing the two is not price action. It is the next two earnings, calls, and the language around bookings. For a beginner watching this happen in real time, the lesson is not to buy the dip blindly or to panic sell a position. The lesson is to separate the event, a guidance cut, from the narrative the market attaches to it, and then evaluate the underlying business quality against the new, lower price. That process takes discipline and time, not urgency. The investors who get hurt on days like today are the ones making decisions in the first 3 hours. So, did the market get it right? Probably partially. Accenture's fundamentals are not broken, but the growth timeline is genuinely under pressure, and the premium valuation made the correction mathematically defensible. The more interesting question now is whether this guidance caution is isolated to Accenture or whether it is the first data point in a broader enterprise AI spending slowdown. That story is what we are watching next. Subscribe to Synthetic Alpha so you get that breakdown when it matters, not after.